Are you ready to explore the fundamentals of risk and return? This presentation outlines key aspects of risk management, from understanding key terms to applying modern theories. Discover how risk and return shape investment strategies. The relationship between risk and return is crucial for investors. Applying the capital asset pricing model helps estimate expected returns. Portfolio diversification and modern portfolio theory are essential concepts. Understanding these principles can guide investment decisions. This chapter sets the foundation for exploring these topics in depth. The risk-return trade-off suggests higher returns come with higher risk. Risk is the possibility that the actual return will differ from the expected return. Return is the gain or loss on an investment over time. Diversification reduces exposure to single risks. Systematic and unsystematic risks are key concepts in investment. Risk and return are the twin pillars of investment analysis. Every investment carries some risk, but also potential return. The goal is to balance risk against expected returns. High-risk investments demand higher returns. Government bonds and venture capital illustrate this trade-off. Risk can be systematic or unsystematic. Systematic risk affects all securities and cannot be diversified away. Unsystematic risk is company-specific and can be reduced through diversification. Understanding these risks is crucial for portfolio management. Diversification is a key strategy to manage unsystematic risk. Modern portfolio theory shows how diversification optimizes returns for a given risk level. By combining different assets, investors lower overall risk. Stocks, bonds, and real estate create a balanced portfolio. Diversification spreads risks across sectors. MPT is foundational in investment strategy. The capital asset pricing model calculates expected returns. It uses the risk-free rate, market premium, and beta. Beta measures a stock's market volatility. A beta over 1 means more volatility than the market. CAPM is widely used in finance for equity research. CAPM calculates expected return using risk-free rate, beta, and market premium to estimate equity cost. CAPM assumes compensation for time and risk. For example, a risk-free rate of 3% and beta of 1.2. The expected return calculation is essential for investors. It helps estimate the cost of equity. The risk-return trade-off is a fundamental investment concept. Understanding it helps investors make informed decisions. The 2008 financial crisis showed the dangers of misjudging risk. Institutions invested in risky mortgage-backed securities. When defaults rose, the market collapsed. Diversification could not protect against systematic risk. Safer investments like Treasury bonds preserved capital. The crisis highlighted the need to distinguish risks. Systematic risk affects the entire market. Diversification is not a shield against it. Investors learn to value safer assets. Understanding risk types is crucial for future stability. Diversification is central to modern portfolio theory. It reduces unsystematic risk in a portfolio. By mixing asset classes, investors achieve balance. Diversification does not eliminate all risks. It is a strategic tool for managing investment risk. Volatility measures price variation in assets. High volatility means higher potential returns and risks. It is often measured by standard deviation. Investors must assess their comfort with volatility. Understanding volatility aids in making informed investment choices. Beta is a key component in the CAPM formula. It measures a stock's sensitivity to market movements. A beta over 1 indicates higher volatility than the market. Stocks with a beta under 1 are less volatile. Understanding beta is crucial for risk assessment. Volatility impacts investment decisions significantly. Investors must weigh potential returns against risk. High volatility can lead to substantial gains or losses. It is crucial to align investment choices with risk tolerance. Understanding volatility is key to strategic planning. Research analysts must understand risk-return dynamics. It is essential for making investment recommendations. Analysts match opportunities to investor profiles. Understanding risk helps in portfolio management. It is vital for accurate valuation and strategy. CAPM is widely used in equity research. It helps estimate the cost of equity for companies. By assessing risk, analysts make informed decisions. CAPM provides a framework for evaluating investments. It is a cornerstone of corporate finance. Effective risk management involves diversification. It also requires understanding systematic and unsystematic risks. Investors must assess their risk tolerance. Aligning strategies with risk profiles is crucial. Risk management ensures long-term investment success. Test your understanding of systematic and unsystematic risks. Can diversification reduce all types of risk? Explore the risk-return trade-off with examples. Understand how CAPM calculates expected returns. Reflect on the role of diversification in MPT. Explore more on the 2008 financial crisis. Read the IMF Global Financial Stability Report. Visit Investopedia for detailed explanations. Further reading deepens understanding of risk and return. It is essential for continuous learning and growth. In conclusion, through well-defined objectives and strategies, you now have an understanding of risk and return. These concepts are essential for investment success. Apply these principles to strengthen your financial strategies. Thank you for watching this video.